Good morning, traders. It is Monday, the 11th of July, 2016. It's 8:02 a.m. Chicago time. This is another Trader Bite. Thanks for joining. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The headlines over the weekend and overnight: Japan's prime minister orders a stimulus package after his election win. Shinzo Abe's Liberal Democratic Party took a big win, causing a big push to the upside. The Japanese yen is weaker by 1.8% at 102.38 per dollar. The yen is actually down 2.1% currently. So more stimulus. Remember, Japan is already in a negative rate environment. Deutsche Bank's chief economist says the EU should set up a bank bailout fund uh, in the amount of 150 billion euros. Seeing some issues with some Italian banks and so on. China's CPI slowed. Consumer prices in China slowed to up 1.9% year over year in June. I take pretty much anything China puts out as far as economic figures with a grain of salt. Producer prices fell for the 51st straight month, down 2.8%, and the U.S. dollar hit a 4-month high. The U.S. dollar index hit a 4-month high of 96.79 in early trading. This is a print that bested the March 15th print. And then on top of that, looking across the globe, the DAX is way ahead of everyone else. The German DAX is up 1.64%. It was as high as 97, 94 and a half on the futures. Euro Stocks follows, up 1.38%. Then the mini Russell, then the Nasdaq, Dow, and the S&P. The S&P being up 7.75%. It is in new high territory as we speak, making for an interesting hypothesis environment. Again, the British pound is trading up 1.2991, up 1/4%, and crude oil hovering at 45, 45 and a half or so, going sideways. Crude oil is still in a fairly big channel, downtrending channel, according to my charts. Gold has come off, but it's still at 1353. Okay, and then the weakest markets are the Japanese yen, as I covered, the U.S. Treasury bond market, and the U.S. 10-year. So what this is telling us is that money is moving towards risk assets. There's a risk appetite as we speak. So, with that being said, let's take a look at what we. One more thing. Because it's Monday, I like to cover what we're expecting for the week. So let's start with today. Today, the only thing I see on the calendar is a U.S. labor market conditions index change. I have not seen this number before. Labor market conditions index change comes out at 9 Central, 10 Eastern. The prior is negative 4.8, no current estimate. We also get the Eurogroup meeting starts today, and then we have Fed's George at 9 Central, 10 Eastern. And then looking at the week, this is a very, very interesting week. For tomorrow, we're getting CPI out of Germany. We're getting wholesale inventories and trade sales in the U.S., the JOLTS job openings in the U.S. as well. We're getting a parade of Fed speakers and ECB speakers this entire week. We have Fed Speaker Mester tonight at 8:30 p.m. Central in Sydney. And we get Fed Speaker Bullard tomorrow at 8:35 Central, ECB Speaker Lind, Fed Speaker Kashkari, and then on Wednesday we get import prices, European industrial production, as well as a monthly budget statement. We also get the Bank of Canada rate decision, expected to remain at 0.5%. Again, Wednesday, we're looking for Fed Speaker Mester Kaplan. The Fed releases its beige book, which has been a mover lately. Fed Speaker Harker as well on Wednesday. Thursday, the big one is the BOE bank rate decision. There's an expectation of a surprise here. The number is released at 6 Central, 7 Eastern AM. The BOE bank rate decision. This will be the first move that the BOE will make post Brexit. And then following that, we have PPI core, PPI final demand, and we also have, again, on Thursday, we have Fed Speaker Lockhart, Fed Speaker George. As I said, every day they're sprinkling Fed speakers and ECB speakers on the markets. Then finally, Friday, we get construction output in the UK, we get retail sales in the US, CPI, CPI and CPI core in the U.S., empire manufacturing, industrial production, capacity utilization, business inventories, and University of Michigan conference preliminary. That's a mover. That comes out at 9 Central, 10 Eastern. And yet again, on Friday, we have Fed's Kaplan, BOE Speaker Carney, and Fed Speaker Kashkari, and that pretty much wraps up the week. Okay, before I go into looking at what we have done, what we did on Friday, I want to let everybody know that I am not going to be doing any Trader Bites from July 14th onwards, from Thursday onwards. There will not be any Trader Bites. In fact, I will not be tweeting or doing anything. I'm going to be traveling from July 14th to the 24th, and I will be silent. And of course, please mind your risk and make sure you stay in the game while I'm gone. Not like I'm doing that for you, but it's important not to lose your cool and focus on the market. Let's take a look at what we've got. If we look at Friday's pre-recorded Trader Bite, there we go. This is where we were. Remember, Friday gave us non-farm payrolls. We opened up in a gap at the time of the Trader Bite, which was pre-recorded. We were trading at 21.08. The expectation is an attempt lower to try to close the gap at 21.02, likely to fail, and then targeting 21.1675. 21.1675 being the first measured move. There's a double measured move up in the 21.28 region that we almost got to, but the primary hypothesis did play out on Friday. The secondary hypothesis, which looks very similar, is not one that has responsive selling back into the range. It is one that opens in a drive and pushes directly to the measured move high and then rotates down to respond to sellers, rotates down back into the prior range of 21.02. That's what that arrow shows. So Hypo 2 looked for a push up initially, find sellers, advertise prices high enough to shut off buyers, bring in the sellers, and then rotate down. That did not happen. Hypo 1 actually took place. So here's what Friday looked like. Pretty much just like the picture, except it pushed much further up than expected. Friday, I had a modest goal of looking for a target of 21.1675, 21.17. We saw the market pause there, but then it continued to push higher into the late part of the session. We have a P-shaped profile, and the point of control being near highs, but the market did not close near highs. It did close above the IB. The IB was broken only on one side. This is technically a trend day. The range for Friday was a little over 20 points, about 22 points. So overall, this is a trend day. I did not update the flex levels over the weekend. I was just slammed over the weekend, but I'll do that this morning when I get a chance. But overall, the market is has resumed a healthy trend up, as we had talked about since Brexit. The idea behind Brexit is we drop, we regain 2042, stay, if we push above 2042, we are likely to push new highs. Okay, 2110.75 was the prior all-time high in the ES. So let's look at the big picture here for a moment. Let's pull up the composite. Here's the big profile that we've been using for a while. So you can see here before Friday, this is where the 2042 comes from. It is the most traded price in this region. What has the market accomplished overall? It's if you were to look at a monthly chart or a monthly profile. Uh-oh, somebody's in trouble. Okay. If you look at a monthly profile, you'll see that it's just an incredible grind. We have spent just a ton of time in this 200 or so point range, 1900 to 2100. The performance overall is fairly poor. I mean, yes, we are making new all-time highs, but overall, the market is just chopping around. There's a lot of news that's driving the markets. We are still on central bank crack. The market does not move unless there's some sort of a central bank move. And so overall, we're not accomplishing anything. I mean, we've traded the living heck out of these prices here and are pushing new all-time highs. What have we done every time we've pushed a new all-time high? We have sold off. As you can see there, 2110 to sell, 2086 quarter to sell, 2089 to sell. Of course, when does it, at what point does it start selling? So here's 2089 right here, 2089. It finally takes it. The next high sells off right there. I hope you can see that white. Let me switch it to yellow just to be more obvious. So here's the last all-time high. Here's a new high. So we make a high, pull back over the next few days, push up, and so on, and then we sell off. Then next time we get up here, we take out the high is right there. We make a new high, we sell off, and then we push on this one, the 2110, we pushed for a few days, but those few days where we pushed through the 2096 quarter all-time high, we pushed for 2 days, but let me expand this a little bit. Every time it pushed through, so you can see here, it broke the all-time high right here. Then the next day, it puts in a very bearish or very weak formation. It pushes up and finishes and closes right at the open, almost a doji type of setup. Then the next day pushes higher, and then from there it starts to slip. So for me, I'm looking for, fine, we have a high, we have a new high today that we're going to open in a gap zone. But as soon as we make a lower high on the close of the day session, I'm going to start switching to the other side, and then what I'm going to be targeting is the gap zone down here. I'm looking for 2042 and below yet again. So it's this. I do not like, just full disclosure, I do not like this kind of market. In general, markets that tend to have much lower volume. Volume could drop by 40-50%, much lower range. You could compress from a 20-point range to about an 8-point range fairly quickly, and very, very low volatility. And to me, that's just great opportunity for the long-term investor, for pensions, for mutual funds, and so on. The very high OTF time frame, but it's not great for us. So it's a time to be patient. We are in smack dab in the middle of summer here on July 11th. So just chill. Try not to push your trades too far. Just look for opportunities where you can trade with the strength of the market, which means that on these days, and this is my advice to you based on 16 years of experience, my advice to you is wait a while. Wait until the market sets in. Usually by the time the initial balance is in, we have a idea, uh, pretty good idea of which side is in control. So just wait for that. Wait for the market to establish itself, and then step in and risk your money, risk a small portion of your account to see what the probabilities do for you. Okay, so that's how things are shaping up overall. We've left all of the volume behind us. You can see the volume profile underneath, very heavy underneath as we push new all-time highs. Now on Mondays, I'd like to go through and look at the bigger picture and so on. I'll pass on that today. I've used up a lot of your time. For today, we have basically the same type of conditions and the same plan as we did on Friday. This is the Monday after non-farm payrolls. The market has a tendency to continue to play out the number from non-farm payrolls into the first couple of days of the following week, Tuesday being the most likely rally day. But we have a gap, and we have a lot on the calendar this week. But in general, the day after non-farm payrolls, the Monday after non-farm payrolls, there's generally a sense of digestion or a slower type of trade. We often continue to the trend. If it's a worse number, then we generally start to sell off into the Monday session. If we didn't on Friday, if it's a good number, we continue the rally. And here we are continuing the rally. So here we're opening. My primary hypothesis today is yet again an open auction out of range, responsive selling down into, in this case, probably 21, 22 and a quarter, and then for a bounce, I'm looking for 31. The 28, 31 area is this double measured move right here. You can see 21 to 38 is a double measured move, a target that we're in the middle of. I expect the market to get tangled in here, and then I'm expecting it to drop. So overall, for Hypo 1, I'm looking for an open auction out of range. I'm looking for it to respond down, potentially push to 21, 22 and a quarter, and then get stuck here into the end of the session. I'm expecting a balanced day, a balanced condition today as opposed to imbalance. I know we're opening in a gap, but I expect a balanced condition today. There is some risk appetite, but a lot of the move has occurred overnight, and there's a lot going on overhead. I'm expecting an attempt and a pullback, then sideways for the rest of the session. That's the primary hypothesis. The secondary hypothesis is because we are in an open in new territory, there's an elevated risk of an OTD OD type of opening, meaning a higher time frame stepping in as more and more moving averages cross to the positive side, as more and more systems. Remember, in my opinion, and based on a study I can't reference right now, I don't recall, but the great majority of the algorithms and systems that people follow, managers follow, are trend following, and as time goes on, more and more of those are likely to trigger. And so this for Hypo 2, I'm looking for an open test drive, push higher and start to make its way up. And again, these arrows are very short because we are in new all-time high territory. If you go back in time and look at new all-time high bars, you'll find that they're fairly small and stocky and low volume. And that's why I expect the range to be fairly small. Here I'm drawing about 8 or 9 points. I don't expect too much out of these trending hypotheses. 3, 4, and hypothesis 3, 4, and 5 don't need to be covered. I've already taken up a lot of your time. Again, I want to remind you, starting Thursday onwards, no trader bite, no tweeting, no presence for 7 days. Okay, I'll be back on January 25th. I'll continue to operate as normal through Wednesday this week. Good luck, and I'll catch you later.